Good afternoon, ladies and gentlemen, all of our existing investors and all of you that are new to OrbVest here this afternoon. Thanks very much for joining us. It's great to see such a nice turnout in the afternoon. This certainly is an experiment, and for those of you who did watch the Alec Hogg show last week, we were quite surprised at the amount of traction we get on the lunchtime webinars. So I think the question that I'm going to put to you a little bit later on in the poll is, do you prefer the lunchtime webinars to the 7 p.m. webinars in the evening? I think we have had some feedback that potentially the 7 p.m. is a little bit disruptive. So if this is a more popular time, we will keep them short and sweet for those who are just looking for product information. And so we'll put that poll to you a little bit later on. As per our learnings over time, we don't give an insight into OrbVest. We are here specifically to talk about MED29. But for any of you that are new to OrbVest, please stay online. We will talk a bit about OrbVest afterwards, and I'm very pleased to also welcome today Martin, who's woken up very early in New York to come and join us, and you will see him shortly when we share screen. So Martin, just trying to get to you right now.
Perfect, Justin. I can actually hear you. Greetings to everyone online. And as you can see, it's nice and dark behind me as we move into fall and winter. And hopefully in the next couple of minutes, you'll also see sunrise. So welcome to everyone.
Thank you, Martin. Just our normal disclaimers. Just for those of you who are not familiar with us, we have investors online today that are from different parts of the world. Just to be absolutely sure, we do always show this disclaimer. So please bear in mind that we are here to present our product. We are not here to give you any tax advice, any investment advice. We do recommend that you consult with your financial advisor. And if there's anything that you don't understand about today's presentation, or if you decide to go ahead with the investment. But of course, if you're investing from South Africa, we do operate under the license of the FSCA, and that license number is on the screen here. It is 41690. If you're coming in as an accredited investor from the USA, obviously we file with the SEC under Reg 506C. And so after those formalities, let's talk a little bit about what OrbVest is briefly for those of you that are new to us. We are a company that invests in stable income producing assets in the USA, and very specifically, our niche is medical real estate. We do nothing else outside of medical. We do nothing else outside of specific states in the USA. And we do not touch any buildings that have a high level of risk. We aim at buildings that are profitable, that are already generating reasonable returns. And of course, the challenge for Machiel, who will come in now, we will introduce you. The challenge is that he needs to find a little bit of upside so that we can have some capital growth at the end of the 5-year period. But once again, we'll tell you a little bit about how OrbVest operates after we've got through the deal, our latest deal, which has been live for 3 weeks already, and that is MED29 in Phoenix, Arizona. So I mentioned Phoenix, Arizona, guys, and I think that's a new name for many of you online. So I'm basically going to talk about how we invest and how we identify specific states. For all of you old investors, you will remember that the investment committee specifically steered by Henny suggested that there were certain absolute criteria for real estate. In order to have real estate that is more valuable in 10 years' time than it is now, there are 3 things. 1, GDP growth. If you are in a growing state, there's a very good chance that there's going to be more demand for your building in the future than there is today. 2, population growth. We absolutely look for states that have radical growth in population. And 3, we have identified, and we'll get to it after the presentation for those of you that are new, that aging population and people that are migrating from cold climates to warm climates are very attractive because they tend to spend a lot more on medical services than people that are in the younger demographic. So that's basically it. We started off, we did a lot in Georgia around Atlanta, and then we moved into Texas, and we've done a lot in Texas. We love those two states. We have a lot of IP and knowledge, and of course, we have an office in Atlanta. And more recently, the investment committee approved New Jersey. We now have 2 buildings there. For those of you that invest in Princeton, we have just listed that on the exchange so that we can put that dot in there by the time we present to you next. Of course, under Machiel's request, the investment committee did approve a bunch of other states here, specifically Colorado, Utah. The big ones are Florida and Arizona. We decided to focus on Arizona, and Machiel will tell you a little bit more about that. Machiel, I think this is getting to your space now. Tell us about this building that you found and how it's going so far.
Yeah, thank you, Justin. We've been really trying to enter the Phoenix market, and the slide that you guys are seeing currently on the screen is really personifying one of the main reasons for it. We've just seen an absolute growth in that, specifically Phoenix, the city, and the city is on track to become the 4th largest city in the US. It's a phenomenal growth. What we initially also looked at is just to make sure that the demographic is just not the older people moving there, because we always would like to have a balance. And to our surprise, we found that the demographics in Phoenix is fairly balanced. Yes, there is a lot of people retiring there, but we also see that there's a very, very vibrant bio and medical research corridor with a lot of training. So from that perspective, yeah, we are very bullish about the city. And I'll talk about another opportunity that we also are going to pursue in the city. So all in all, from our perspective, we're very happy to be in that market as we speak. The building that I'm going to talk to is then located near the airport, but in what they call the Research and Innovation Corridor. I think that's very relevant for us from a medical perspective. It's surrounded by 4 hospitals, which I'll go into just now. But from a global scale, it's really in the right location, and it's also busy with a master plan development where they are going to add another 40-bed hospital in the region. So all in all, that specific area is really growing. We've also seen that there's a huge influx of medical type growth from a job perspective. So yeah, so that is really the attractiveness of the location. If we can go to the next slide, Justin.
Great, Machiel. I just, I mean, these particular points on the slide are fantastic. I mean, the 36% projected employment growth in this particular healthcare corridor is fascinating, compared to like 21% growth nationally. I think that's fascinating. And then the other thing is that Phoenix as a city is what the 5th biggest city in the States. And in the next 2 years, anticipated to be the 4th. Is that correct?
Yeah, no, it's growing so fast that it's basically, I think early next year, it will be the 4th largest city in the US.
And just before we actually just jump onto the building, I just want to give a personal anecdote, and that is that we know people in the east side of America, in the New York area, who are actually moving across to Arizona right now. And it's just because of the fact that, with COVID and the ability to now work from home, and the fact that Arizona is so affordable and the climate's so preferable, it's a great place to live. And so you really do notice a huge influx. The question is, why Arizona, not Florida? It's because Florida has become quite expensive from a real estate perspective and affordability there. So it's a great destination. We believe very strongly in the fundamentals at OrbVest in Arizona, and so do a lot of other people in America. And that's the reason why it's been difficult to get the right deal for OrbVest over the last almost year now. We've been trying to make inroads into this market.
Yeah, so to this end, just a highlight of the building, you'll see it's roughly about 50,000 square feet. From our perspective, that's something that we really look at. We avoid the really, really small buildings, like 10,000 square feet and lower. Occupancy in this specific case is 92%. one of the key principles that we're focusing on is obviously that we don't want to risk the investors' capital. So what that means from a deal perspective is that we must be absolutely sure that we can pay the rent. And this is just underpinned by the key tenant, which is roughly about 60% of the building that's got a AAA Moody's rating and, sorry, a AAA S&P rating. And for those that know about that, that's pretty much the highest grade that you can get. The building is relatively new in our terms. So from that perspective, it's on a campus with another 3 hospitals. So it's very recently built. From our perspective, it's very, very nicely maintained. And I'll go into the details of that just now. And then I think the other major item is that it is has got a 7-year weighted average lease term. And from our perspective, that is pretty good because, you know, our focus is to exit pretty much before year 5, year 5 more or less. So from that perspective, it really then also leave some lease term left on the leases, and therefore bodes well for the selling. All right, so let's move on to the next one. Yeah, so I've just alluded, it's a little bit busy, this slide, but I think it's important that this is on a 3-bed hospital. This is Justin is pointing at the St. Luke Medical Center. This is hospital next door. This hospital at the moment is being earmarked to address the COVID overflow from patients. And then if you look a little bit to the right-hand side, there's some rehabilitation hospitals, and they are pretty much where this open site is. They're going to start the 4th 40-bed hospital. We just learned about that. And then the parking area around this building, you can see is lightly colored in blue. The seller has recently added or renovated that. So from our perspective, that was just very recently done. Insulation that they've done. So yeah, it pretty good from that perspective. When we look at the internal side of the building, we actually as OrbVest has visited the building. So from that perspective, the building has got its major tenant. They have moved in earlier this year, basically January this year. And that means that 1.3 million has been spent pretty much at the end of last year. So absolutely superb quality. Andrew, my colleague, was actually at the ribbon cutting facility, or ribbon cutting function for this community college. And this college focus pretty much exclusively on offering training courses for nurses. And it's an accredited center, and it's part of a group which is quite large. Then the resurfacing of the parking I alluded to. So you can see it's $1 million is $1 million that they've spent on that. So that means that that's all inclusive in the price from our perspective. And then the other 2 tenants, which has been in the building for about 3-4 years, the Steward Healthcare, they spent also roughly about 500,000. So all in all, our assessment currently, we're still busy in the due diligence, but our assessment currently is that the building is in a very, very good condition, and we don't foresee to spend major additional money on the, let's call it the capital expenditure budget.
Machiel, just on those tenants, when Andrew got back, it was important to note that they anticipated to actually run nursing training 3 times a week. Given the large influx of people into the healthcare sector in the US post-COVID, and them realizing that it is resilient from a job perspective, they're now running it 6 days a week and exceeding their expectations dramatically. So they really are doing exceptionally well in this building from a tenant perspective, which bodes well for the landlord.
Yeah, no, that is for sure. Then on these graphs on the left-hand side, I want to just illustrate what we also look at very specifically is what is the rental growth and what is the rental level. So on the left-hand axis, you can see the scale is roughly $19 to $20 per square foot. And on the right-hand axis, you'll see it's a percentage from roughly 0% to 3%. And if you can see, the line indicates that it's roughly a 1.71% year-on-year rental increases. It's a little bit basically affected by COVID, but all in all, they are achieving above inflation rental increases. So that's very nice for us. And then the net average rental in this building is roughly about $19 per square foot. And so what we want to achieve with that is that the other two spaces, which I mentioned, is roughly about 30% of the space is occupied by Stewart Healthcare. They also own the hospital next door that is earmarked for COVID. And this is where the opportunity lies in this investment opportunity, is where we are going to replace those tenants that is currently still paying rent but not occupying the building. So from our perspective, if we can then release or sublease those spaces and position the building, we will then add great value to this opportunity. From a selling price perspective, you can see we've got a really huge discount for buying it in this way. And the main reason for that discount is specifically because those two tenants are not yet, or they were occupying it, but they're not occupying at the moment. So from that perspective, if we then can add or replace those tenants in the earmarked 2-year period, the value that we'll add is tremendous, because then the value will be recognized in the price, and then we will stabilize the property for roughly 6 to 7 months, and then we'll position it to sell. So that is the business plan from our perspective, and you can see the market figures that we obtained from Revista reflects exactly our position in this case. Yeah, so I think what is really driving the credibility of the rental is the community college lease. You can see it's really 10 years and it's all the way out to basically 2030. So from that perspective, this is the tenant that's got AAA rating, and this tenant is also integrated in all the major hospitals and also is effectively a state-owned community college. So it means that the guarantee is basically the highest possible sovereign risk for us. So that really drives that. And then you'll see the St. Luke and the physician centers, both of them are owned by Stewart Group. They will continue to pay rent. So we've got roughly about, like I mentioned, roughly about 3 years actually to replace that lease. So our intention is to replace that within 2 years. We have contracted pretty much some of the top leasing agents, and we've got really clear plans with them already in place for that. We actually had the first tenant already in the due diligence period visiting the building. So I think we're making great headway on this potential change-out plan that is part of this business plan. Yeah, so Maricopa is a community college. It's a brand new lease, like I mentioned. They also spent $1.3 million into the property. And like Martin alluded, they went from 3 days to 6 days. So Martin, we just heard about yesterday, they're actually now opening 7 days a week. So they're overflowing. There is a potential that they can also expand their space. I think from my perspective, it's an excellent feeding ground for the nurses that is being trained there. And they are basically on campus with another 3 hospitals and soon to be 4 hospitals. So from that perspective, the location is perfect. The St. Luke or the Stewards Group per se is also a huge company. So we don't have any problem with the credibility. We're busy obviously checking that. But from our perspective, credibility-wise, we're absolutely clear that this investment is at 92% occupied for 3 years, really will pay the bills, like we know. And it actually gives us ample time now to replace the Stewart Group. And so from that perspective, it's actually a very nice opportunity in the sense that if we then put in other tenants, we will then have a period where we can actually work in the building, do the work, and then once the new tenant starts paying, we can actually swap out with Stewart. So we believe that will be a minimal disruption from a rent paying perspective. But as soon as we achieve that objective with the new leases in place, then the value is being added to this property. So I think we're hitting both objectives. First, to make sure that we can pay rent, so therefore preserve capital, and then the next step is to add value to this investment.
Great, Machiel, there have obviously been quite a lot of questions with that, so thank you for explaining. So, Martin, I see you put your mic off. I don't know if you were going to chip in here. No,
all good.
Yeah, I think just to summarize again, because I know we're going to get questions at the end on this. This is an opportunity. The fact is that this is a large tenant. They are not occupying at the moment because of the fact that the hospital has been taken over for COVID overflow. And so therefore there was no reason for the doctors to support the hospital next door. And as far as their rationalization is concerned, we don't think they're going to occupy anytime soon. So it does present an opportunity. While the rent is guaranteed for 3 years, we can fill the space up with a tenant on a longer lease, which adds value, as Machiel said, and I think that's very important to know. So we see it as an opportunity as opposed to a problem.
Thank you. Let's go on to the next. Yeah, so from a purchase price perspective, you can see we've got it at 8.6. So the all-in purchase price is at the cap rate of about 8%. So from our perspective, for those that doesn't know about the cap rate, if it goes down to about 5 or 6, then it's a very expensive building. If we can get it roughly at 8, it just bodes well. That basically means that we have really paid for the main tenant, and the other 2 tenants has been discounted in the price. So from that perspective, you will also see that we have included 457 and 160,000. So it basically means that the space that's already properly built out, if a new tenant does come in, we can then obviously just touch up and refurbish that space. And obviously, if they want different room configurations, then we can do it from that perspective. So we got that in, and then the leasing commission is really, we are using really the top leasing agents in Phoenix to help us to get this in. And in our own network, we already got 2 doctors that's already looking at the space. And normally to get a lease in place take about 6 months. So it's a long process because it's a fairly important decision for that doctor. But the one doctor that we are talking to is expected to put a radiology practice there. And he said he's always been looking for a place or a space in that area because of the location of the building. So yeah, it was very positive feedback that we've got. Then from a finance perspective, you can see we very specifically have also lowered the gearing ratio in this investment. It's roughly about 60%. I know it says 57 there, but it's roughly at that point in time. The main reason is that we always want to be conservative in the space. And so from that perspective, we've made sure that it's definitely not aggressive. And then just to cover that, the debt coverage ratio of 2.58, it stabilized over the period of the investment, not below two times. So from our perspective, that's very important. Our criteria is only roughly about 1.8. So it's a very strong situation that we are in from that perspective. In terms of the returns, you will see I have calculated and shown on the first line, or the third line is the cash on cash after tax. This is the situation for our offshore investors that is got a listed share. All the taxes in the project from a US perspective and Seychelles perspective is already netted in those figures. So the 8% that you would receive as an investor is pre-tax in terms of your own tax capability or tax position. So on the 8% which you will receive in your wallet account on our platform, you will then pay the relevant dividend tax in your tax residence. And for most people, that's typically in the region of about 20%. South Africa's 20%. I know most of the other international countries is between 15 and 20%. So from you as an investor, you don't have to worry about the taxes on the project side. You just look at the net and you then take that to your tax consultant.
Thanks, Machiel. We had 2 questions on that. I think you've answered them, but I'm going to read the questions out again. What is the expected pre-tax annual dividend payments in USD? And that you've covered. It's 14.5 pre-tax. And then the next part of it is, I understand that the dividends taxed to SARS and any other bodies will be paid by OrbVest. Please confirm that is correct. I think you said that it's not correct. It is free of tax to the Seychelles, but once you draw it out of the Seychelles into South Africa, or you would have to declare those foreign earnings, then you would have to deal with your local tax in South Africa. Happy with that, Machiel?
That is correct. I just would like to add, we obviously do also pay any relevant taxes in the US. So to that point, the difference between the 2 figures that is encircled in the red circle is that on the capital gains tax at the end of the project, we do pay US tax, but that's a tax paid on the project. So the investors that is investing in the US, they will get the 14.5% as they pay the full tax in their personal capacity. For the offshore investors, that would be 13%. And then we translate the capital gain also into a dividend nature return to the investors, just like the 8%. So from an investor, an international perspective, all that you have to do is take those figures and you would then put that into your tax return and then pay the tax due to your own authorities. So from our perspective, the figure that we have made a good guesstimate of, and that is the disclaimer always in this case, is the capital gains. From our experience, we've been fairly accurate with that, but we also make that extremely conservative. I can tell you that if it goes well, the likelihood of that is going to be better than that. But like always, we are very conservative with these figures, obviously within reason. So we're fairly confident that this is the direction this investment can come. The other disclaimer that I just want to tell investors up front that is not used to us, in our documentation, we also say that if it makes a little bit more sense to sell it a little bit earlier or a little bit later than the 5 years, we will optimize it so that it's the best possible return for the investors, and the investors will, the OrbVest and the partners with this deal share in the upside. So we all share if it goes well, and we don't share if it doesn't go well. So all our interests are fully aligned with this project. So from a...
if I can just jump in. Sorry, if I can just jump in, also just mention to new investors on the webinar today, the IRR, which is known as the internal rate of return, is really the culmination or the aggregation of your dividends that you receive on a yearly basis together with your capital gain. Those 2 amounts together, which is your total profit over the 5 years divided by the period, gives you your total return. So you can see, whilst you're getting 8%, give or take, in dollars per annum, paid out quarterly, so that would be around 2% per quarter. If you add that together with your capital gains, you're actually looking at double-digit returns in US dollars per annum projected.
While you've got the mic, these are obviously the reasons why the deals team loves this deal, but perhaps you'd like to just sum up and talk about the deal. Why do you like it?
Absolutely. So I think that in terms of the states we operate in the US, there's a couple that really do tick all the fundamentals. As we know, Texas is one. You've got Atlanta. You've then got New Jersey, where we've been purchasing, which is so stable, literally 2 hours from where I live. And Arizona, we've been going after a long time. And so I'm delighted that we've now got a deal in Arizona in terms of all the migration, the population we've spoken about. In terms of this particular deal, having these 2 solid payers in terms of the next couple of years and the ability to acquire at the right price per square and pretty much get an off-market deal is always first prize for us. And then in terms of the other value add, we've spoken about the fact that It's also difficult in this environment to find a building that generates good solid cash on cash and provides the IRR and the value add. This building does that. In many of our acquisitions, we try and see if we can almost acquire a new tenant to fill some of the occupancy space before we even close the building. And in this building, we're well on track to already finding 1 or 2 tenants. So we are very comfortable that going forward, we should be able to generate nice value add in this building and maintain not only the dividend, but also a decent IRR in double digits.
Great,
Yeah.
thank you. Thanks, Martin. Let's, before you disappear off, Machiel, because I believe you've got some other interesting stuff in the pipeline, which maybe you'll share with us shortly. But, you know, we have had a few questions, and I'm going to just read through them on the screen, if you don't mind. Is there any protection that investors have against fraud, malfeasance on the part of management? Martin, I'm going to point that one at you.
Perfect. So the first thing to understand is that the company OrbVest and the deals are 2 completely separate entities. So what happens is very important that people understand, we call it the vault. All deals are listed separately. Investors go into those structures separately, and we have strong property partners that manage the buildings together with ourselves. If anything were to ever happen to OrbVest, the building would continue seamlessly. The next thing is we do have insurance in terms of OrbVest across all sectors of our company in case something should happen. And that's the reason why we have, for a long period of time and going forward, believed strongly in that investors are always protected against something going wrong with OrbVest.
So, Jude, yes, you know, we can certainly engage in that at another level. We have put enormous amount of risk mitigation strategy in place. We have a risk committee, which has some very interesting key individuals, and maybe if you stay online after the actual Med29 presentation, we can touch on that. But I'm pointing the next one at you, Machiel. What are the closing dates of Med29 anticipated to be?
We anticipated to close mid-December. So from our perspective, on a transactional level, we expect to close mid-December.
Good question. Maybe I'll take this one. Why does it take so long for funds to be transferred from committed capital to investment on the dashboard? I assume no dividends are earned while the funds are not in the investment clarifier. Okay, Devin, this one is for me, I guess. So on the platform, for those of you who have been onto the platform, there is, once you've moved your funds into the capital account of PKF, it reflects as funds in your wallet. Once you make an investment on the platform, those funds move out of your wallet because they're not available anymore into committed. At that point, the funds are still actually sitting in the PKF escrow account. And then only once the project is fully funded and we are able to close the deal, do we apply to the exchange, the merge exchange, to list the building. And only once we do that can we move that money from committed into the actual investment category, because then the investment is made. Your money is then converted from PKF trust account to effectively move across to the US, ultimately into the SPV that owns the property. And then, of course, you end up with your equity instead of committed capital. So long answer, Devin, but I hope I gave that correctly. Sajid, do I invest in rands and SA and you send the dollars across, or would I need to send the dollars across from SA, Machiel?
Basically, you invest in US dollars on the platform, then you will get the required US dollars that you need to invest. So you then transfer from South Africa the required rands at the relevant exchange rate in partnership with your bank or with your foreign trading company. They will then convert the required number of rands into dollars. So when it arrives on our platform, it's a dollar-based investment.
Machiel, if I can just add to that, in terms of most people that are unfamiliar with moving money offshore, it really is incredibly simple. And, you know, our clients around the world have been doing this for a long, long time. You know, every person is allowed R1 million for themselves and their spouse, and then an amount for their kids. And there are no questions asked. If it's within your $1 million discretionary allowance, you simply go to your bank, you move the money offshore. You just put it under that category and they'll move the money offshore for you. It's very simple. It's only when you get to larger amounts that you may need to make sure that you engage with someone who we can refer you to, who can easily move the money offshore and make sure your documentation is correct. But for smaller amounts, it really is very simple and easy nowadays.
Thanks, Martin. Michael, is the capital gain received in the Seychelles taxed in SA as a dividend or a capital gain? You did cover that, Machiel, but just if you don't mind explaining again.
Yeah, Michael, the dividends or the capital gain in the Seychelles is transformed and we return a dividend to you, and the dividend is taxable in South Africa if your tax base are in South Africa. Then the second question is the capital gains tax is not available as a credit. We actually pay capital gains and a combination of withholding tax in the US, and the US corporation is owned by the shareholder, which is the offshore company. So therefore, that credit does not pass through like it would have been if you would have been investing directly from the US side.
Also, just to clarify, there are a lot of people, by the way, when you hear this and it goes into your wallet and you get transferred back to South Africa, there are a lot of people that have offshore structures. And it's important to understand that these dividends actually don't come back to South Africa. They actually just get reinvested into other projects, number one, or alternatively go back into people's accounts overseas. It's purely what Machiel and Justin are describing as wherever you disclose your tax in the world, that's where you need to take this into consideration because you've earned some revenue somewhere in the world.
Thanks, Martin. Two final questions, and I've just moved back onto this slide, Machiel. The question is, what percentage of the carry that OrbVest takes on the profit? And the second part of that, that was from Arashad. The second part of it, I note that the sponsors shares in 25%, although their contribution is smaller than the investors' reasons.
Yeah, so I think the percentage that OrbVest share on the profit split is 25%, as you can see on the outline. With regards to the question in terms of the sponsor, remember what the sponsor does is the sponsor actually stand surety for the bad boy carve-out clauses for the loan. So their contribution is actually much more than the investor's contribution because they are obtaining the loan, which is roughly that 5.7 million. So from that perspective, they are taking the risk for that. And therefore, although they've got a smaller capital contribution, they still have the risk and therefore has to be basically remunerated for that. So what we also have said is that our sponsors should co-invest with us in the project. And that's the reason why you will see on all our projects, our sponsor are co-investing with us.
Machiel, if I can just add to that also, one of the things we often talk about is the 3 areas of revenue that we generate as OrbVest, which is completely transparent. The first is an amount up front, which is a due diligence fee, which covers our operations pretty much around the world and our various expenses, and is below what is normally in the US. Then the other important thing is that most companies in the real estate game charge what's known as an AUM, assets under management fee. And this fee generated on a yearly basis runs, as we know, in most sectors between 1% and 2%. We charge a lot less than that. And our rationale is the fact that we shouldn't charge too much up front or in the middle, but at the back end. If investors don't make money, we don't make money. If investors make good returns, we make good returns with the investors. So we always are aligned with our investors. And those percentages you see are consistent with most players in the world.
Thank you, Martin. We're coming on for 40 minutes, so I'm going to press along. I just put up a poll quickly, guys. We have just done a brand refresh, and we're very pleased by the looks of the poll so far that most people are loving it. So thank you for those who voted. I'll give you the results when we end the poll. But Machiel, before we lose you and get on with the remainder of the presentation, perhaps you can tell us about why we're letting you go off early, and what are you working on at the moment between now and the end of the year?
Yeah, we've basically focusing on to get the following 3 projects onto the platform. So it's a little bit of a sneak preview. I'm not going to give you all the details. We would like just to finalize the contractual details, but we are very, very close. So the Medical 30 building is going to expand our portfolio in Phoenix. So that is a very nice opportunity. As you can see, it's a little bit bigger than the one that we're busy with already. It's about 70,000 square feet, and we believe that is an opportunity where we can change a little bit of the office tenants into medical. So the value play is going to be in that direction. And if all goes well, in about 2 weeks, we'll come to the market with this deal, and we'll give you the full details. Medical 31 is another portfolio that we're looking at. Is actually a portfolio of 2 buildings. This will further expand our geographical footprint. I'm not going to release which state that one is, but it is really, really where we would like to be for a very long time. So I've earmarked that city from day one. So we're very, very happy. This will be done in conjunction with one of our largest partners, and that one is roughly about 2 weeks away. Justin, if you can just maybe just jump a little bit back, if you don't mind. And then the last one, we have already spoken to our existing Medical 5 investors. We are adding another building to the portfolio of 2 buildings. The main reason why we want to do that is, first of all, this building has got a 10-year triple net lease just signed. So as you heard me previously, we like these long leases. And then secondly, for those that has been following the interest rate track in the United States, the interest rates is very low on the reserve level, but even on a bank level, it moved from the current 5.25 that we are paying. We are obtaining loans roughly in the region of about 3.5% to 4%. So from that perspective, we would like to refinance Medical 5 Phase 2 building and add this building in. For those investors that has missed out on Medical 5 Phase 2, you will be able to join that project now, and we'll pleasantly surprise you on the level of returns that that deal is going to present. It's pretty much a known deal. There's not too much lease up that we're going to do. Really, the value add is the refinance, keep it for 3 years, and then we are going to sell it. So that's a very nice lower risk project that we believe will bode well to diversify your portfolio. All right, so thank you, Martin and Justin. I'm going to jump off here, and hopefully the next time I see you guys, we'll present Medical 30.
Thank you, Machiel. And I just wanted to say to all our investors, you can see the consistency now coming through. We're going to be bringing deals to the platform literally every month or second month going into 2021. These were our plans for 2020, but with COVID, obviously, we had to scale them down, given the fact that people were focused on their own lives. But with the growth that we're experiencing and with the growth in our partners across America, we are really seeing a very strong pipeline of deals come to us, which are certainly proving to be very attractive to our investors. So well done to Machiel and his team. Thank you. See you soon.
Thank you.
Indeed. Thanks, Machiel. And I think before we just get on to the presentation on OrbVest, where seeing as we woke Martin up just before sunrise, you can see the sun coming up there in New York. Well, actually you can't, so I'll jump off for a second. There it is. So I think we also need to just mention, Martin, that you have spoken at length on Alec Hog's show and others about these projects being oversubscribed. I think that we are sitting on $4.7 million of equity that has been promised by investors. And I think it's important just to describe where we're at. So on this particular project, we are technically oversubscribed. What that means, guys, if you are interested in this particular investment, which we certainly are very excited about, then I suggest that you jump in. There is still time, but effectively it is oversubscribed. Martin, maybe you want to just touch on that, because people do ask you why you keep telling people it's oversubscribed, and then they see it on the website.
Absolutely. So there's various phases, from a person saying, yes, I'm interested, to saying I'm committing, to them going onto the system and registering, to then us going through the process of KYC, AML, FICA, etc. And then finally the funds actually being transferred, not yet received, but when they're finally received, then you're in. And so what we say in terms of oversubscribed is that the last couple of phases, when someone is absolutely committed, the money is physically on its way, they're in the process, and that exceeds what we actually have available to sell. And at that point, it is oversubscribed. However, it is still on the basis of first come, first serve. So hence the slight variance. And what normally happens is we then have some investors who then invest, and by then it's oversubscribed. And so they simply have to have their wallet funded, and they have to wait for the next deal or one of our other projects.
Thanks, Mart. So for all of you that are existing investors, thanks for coming on today. We certainly will be having a bunch of news coming out, as we mentioned, over the next month. So we will let you know as and when that comes about. If you're interested in moving forward, please get hold of your investment consultant straight away. And for those of you who are new, please stay on. And Mart, I'm going to get you to kick off, if you don't mind. Tell us a little bit about OrbVest. And especially, I would like you to answer two questions that are coming up all the time, especially as a result of the situation in the US. And the two questions I'm going to read to you, just so that you kick off on those. How will an upsurge in COVID influence investments in OrbVest USA? Number two, what influence will Biden win have on the US economy?
Perfect. Thanks, Justin. So the first question is, how does this potential second wave affect OrbVest? And so the comforting news is that we now have a history and actual data to guide us in terms of the COVID impact. The first thing is that the majority of our buildings and tenants remained open during the first wave, as medical office buildings were and are deemed essential services. The second thing is most people don't believe that there will be another complete lockdown, but if there was, there is strong consensus that it would be associated with some kind of stimulus or compensation package, similar to the $2.2 trillion package that we saw earlier this year. In these packages, it's important that everyone understands that all businesses, literally in the entire United States, had their rent and their employee salaries covered for 2 to 3 months, which would take us essentially from December right through into February or March, and then we're back into spring. So we can look back and say that we've been pretty much unaffected by COVID. Where we are affected is in terms of obviously restrictions on travel, and it complicates us when we are trying to move new tenants into buildings, as we obviously experience delays. And the last thing on the first question is that it's important for everyone to note that the tenants that we have, these healthcare tenants, are very profitable. They're very resilient. And when you get sick, it's the reason why we believe so strongly in the healthcare niche. You have no option. You have to go and see your medical practitioner to be treated, unlike if you want to go to a show or a movie or the local mall. Then the second question was that we got asked, what is the influence potentially of a Biden win on the US economy and on OrbVest? So the first thing is that as I watch in my first election in the United States, things unfold next week. If Trump wins, we all understand it's going to be more of the same with lower taxes and a strong focus on growing the economy for the next 4 years. Conversely and differently, if Biden wins, his agenda is very clear. He's made it very clear in the following. Number one, he wants to increase taxes and tax rates across all areas, especially on the wealthy. So whilst this may potentially negatively affect the economy, the US dollar exchange rate and potentially equities in the short term, I personally believe it's only in the short term because the economy is currently awash in cash and people need to deploy their capital, so they will continue post-elections to place it into certain areas and niches to stimulate the economy going forward. The good news is that Biden was part of implementing and activating Obamacare and healthcare for all, and the Democrats are determined to extend their push for additional affordable healthcare in the United States to everyone, which will obviously bode very well for the healthcare sector. The other thing to note on point number 3 with Biden and the Democrats is that they are determined to reduce healthcare costs, specifically the enormous profits made by pharmaceutical companies. We are not in the space. And then the last thing I want to mention is that he also is very strongly of the view that he would like to change the 1031 rule on real estate. The 1031 rule basically says, if you sell your building and you reinvest your proceeds within 90 days and you use the 1031 exchange, you can defer your capital gains. So in summary, OrbVest does not use 1031, so we're not affected. And number two, we strongly believe that based on what we saw in the first wave and what we're seeing right now, that medical office buildings will not really be affected under Biden if he should win.
Martin, you're going to do a little bit of an introduction for us as well.
Perfect. So you can see the slide on the screen. And the important thing to note is that the portfolio is now more than $350 million. And we have over 1.2 million square feet of real estate under our management. We target, obviously, our returns of 11 to 17%. And the important thing specifically for South Africans is that we allow people to invest in our projects from a minimum of $5,000. So for literally, around 80,000 Rand, you can now get into owning real estate in the United States. And there's a specific reason we did that. Initially the hurdles used to be, $50,000 or $100,000. And we really wanted to make it accessible for everybody. Most people dip their toe in the water. And then once they receive their dividends, they feel very comfortable. And given its stability, they come back again and again. Justin, maybe you want to touch on the aging population?
Yeah, I alluded to it early on in the conversation. So, I think that as far as fundamentals are concerned, the very important ones are GDP growth and, of course, population growth. But the third one that I touched on was our hypothesis that an aging population is very important for medical buildings. And why? Because the demographic of 65 years and older spend 5 times more on medical services than the demographic below that. And so you would think that if you're looking for a target market where you're going to invest in medical buildings, that would be very important. And so in the US, generally, you will note that the population before 2050 will exceed 80 million people. And we can also make the assumption that that a large proportion of those 80 million people will be living in the warmer climates with lower tax regimes and, as Martin mentioned, a lower cost of living. So we are getting people migrating to these areas like Texas, like Arizona and Phoenix. So very specifically, that is our hypothesis, and this underpins the fundamental. Quite different from hospitality or retail, where the movement is negative. And I think, Martin, you love the numbers, and so I'm going to absolutely give you the numbers to talk about. But ultimately, it's always where the rubber hits the road and what is the track record of these medical buildings that our investors own. And over to you, Mart.
Absolutely. So I think, as I like to tell people my story, and my story was that many years ago in 2012, when I first started to invest in the United States, I was told that I could get returns of between 8% to 10% in dollars. In those days, it was a different asset class I was investing in. It was houses buy to rent. And I was pretty skeptical. And I did invest, and I did receive those dividends every single quarter. Obviously, the 8 or 10% is on an annual basis. And I was receiving my reports every quarter. And I quickly came to realize that, it is very acceptable to get these kind of returns in the United States and still get a capital gain on top of that. And so over the past 6 years, my team has generated these outstanding returns. We continue to generate fantastic returns of around 8% cash dividends per annum on the buildings we acquire. Remember, the reason why we're confident of that is because we don't do developments. We don't take major risk. The buildings we acquire on day one that are income producing. People often ask, but are those returns not too high? Well, if you're getting a building at 6 or 7% and you're gearing it with a 65-35 loan to equity, then you're gearing your return and you do get to these kind of numbers. And we've got investors, as everyone knows, from over 10 countries in the world. So the last thing I'd like to draw your attention to is where you see some of the projects at the bottom, where it shows 5,7 and 5,8. those projects actually are some of our best projects, delivering cash on cash dividends in the second and third years of 10%. But what they do is they start off at the 5.7. We bring in the 1 or 2 new tenants. The moment they're in, it jumps to 7, and then 8, 9, 10, and above. And so that's really where we provide value add. However, our preference is always to try and achieve close to 8% on day one.
And the other things that matter, Martin, and that is when you're giving your money to people, who's actually keeping an eye on it. And I think that it's always important to look at the people standing behind the product. You know, thinking about your question earlier on, Sajid, you know, we now are paying out dividends in excess of $1 million every quarter. In fact, growing quite nicely. We hope to tell you soon that it'll be $2 million, but we got a little work to do. If COVID wasn't there, maybe we'd be there already. But Martin, who you've heard of today on the screen, has a very long record of building companies to scale. I'm sure none of you have taken out a short-term loan from Bayport Financial Services, but he was instrumental in turning that into a leading financial institution. My background that many of you will know of is from private property and One Africa Media. But of course, one of our absolute key people is Henny, who has been busy in South Africa for the last 30 years and has the biggest private portfolio of medical real estate in the country. So that's discounting the REITs and the institutions. So he has a significant amount of IP in the space. And I would invite you that if ever we have a webinar with Henny talking about the disruptive interests of medical and healthcare, you must attend, because it's fascinating just listening to him talk about it. Machiel, you met earlier on, and of course, Lofulian, our Chief Financial Officer, who has a history of working in some major listed property companies, and more details on that if you'd like. I also mentioned, Sajid, when you asked questions about risk mitigation and the executive team, I think that in an organization like this, where we do have to look after other people's money, we are not always right. People are not infallible. They make mistakes. So it's important that you bring in a team of people to basically analyze the decisions that are being made and make sure that every single risk is mitigated. And for that purpose, we have all these committees that you would have in a public company, established with very, very strong people. And I'm just going to pick on 1 or 2 of them. First of all, non-exec directors. You'll see we've got James Saperstein, who is the CEO of one of the big pharmaceutical companies in the US. We've got Darren Jacklin from Canada, who also is a director of a NASDAQ company, who has a very interesting track record in helping companies to scale to the NASDAQ. And then, of course, one of the biggest property investors in South Africa, Bharat Mehta. And then just picking on some of these guys in the pile here, but Tini van der Mest is one of the most well-known people in the financial services space, certainly putting a lot of pressure on us under the auspice of our FSB license. He was a non-executive chairman of TBI, Sasfin, and of course, CEO of Sanlam Investments in India. But very, very strong credibility. And I'm not going to bore you with others. Maybe Eric Gonzalo. Eric is with Grant Thornton in the USA. He's the national leader of healthcare and specializes in compensation, heading up our remuneration committee. So very powerful team that we're getting together. I'm actually pleased to mention that Tini van der Mest has joined us as a director of OrbVest South Africa. And that's very important, because that's where our FSB license will sit, or does sit. And so very important we get all that correct. And ultimately, who gets to make a decision about your property investment? How do we make sure that Machiel doesn't bring us properties where there are potentially risks? And this is the team that actually ultimately makes the decision. In fact, the decision is dominated by the 2 guys on the right, David Vandrach and Alan, who are completely independent. And David, very well known in real estate circles, for those of you who are in the real estate, commercial real estate game. He was instrumental in launching a property finance business at RMB, and most notably Ashburton. I'm having a problem with getting my words out today. He was the head of credit of several banks, including Investec and Rand Merchant Bank, and is just overall a top-notch individual. So very important to understand that we don't get to decide what buildings you get to invest in. They get to decide. Machiel will bring them buildings that he finds. He will try his best to motivate for them to get them over the line. Ultimately, it's them that say yes or no. And unfortunately, no is the answer that comes up more often than yes. So I think that's really all on the OrbVest side. Martin, perhaps if you would like to wrap up, we are coming on for an hour now, so I would like to close the meeting.
Absolutely. Thank you, Justin. And thank you to everyone for coming online today. And, you know, as OrbVest, we really are humbled that we're in a position to be able to really fill the niche of being able to find great assets in the United States and to take people by the hand and let them invest into these great properties and earn dollar dividends. And we've seen over time how people get involved. They do their first one, their second, their third. Eventually, they build up like a mini portfolio of real estate in the United States. And whilst your currency and the equities market are bouncing up and down consistently, the one thing that gives people a lot of comfort is they know that they're in safe, stable buildings. They're getting their dividends every quarter. They're building their wealth. And so we just thank you for your support again. And we look forward to bringing you many more of these buildings going forward in various products. Thank you.
Thanks very much, Martin, and thanks for everyone for attending. I see there's some last-minute questions popping in. I don't want to keep you. It's longer than an hour. Michael, Archer, if you don't mind, shoot me an email. I can certainly give an answer on that. In fact, let me just, we're ending, but basically the question is, when do we get updates on the individual projects that we have invested in? And you will note that around about this time, every quarter, you get a substantial report on the particular investment. So for instance, 300 will be going out in the next a day or so, and that will be a market assessment of what's happening in the area, how your investment is, what sort of dividend you earn, et cetera, et cetera. So that goes out quarterly. On top of that, we do a regular, sometimes not that regular over COVID, but a regular email which has various news points on what has happened in any particular building. And then you can touch one-on-one with your financial consultant from OrbVest, who will be able to fill you in on any details along the way, or of course, reach out to us. We're very happy to chat to anybody at any time. So thanks for that. And thank you, Jeanette, for joining us on our own webinar. Goodbye. And again, see you next time.